The U.S. trade gap widened to a record high of $74.4 billion in April, as exports fell and imports rose. This means that the U.S. bought more goods and services from other countries than it sold to them. But why did this happen, and what does it mean for the economy? The decrease in exports was mainly due to lower shipments of industrial supplies and materials and consumer goods. These are things like chemicals, metals, fuels, plastics, machinery, and electronics. Some of the reasons for the drop in exports are: the global pandemic disrupted supply chains and reduced demand for some products. The strong dollar made U.S. goods more expensive and less competitive in foreign markets. The trade tensions with China and other countries imposed tariffs and barriers on some U.S. exports. On the other hand, the increase in imports was driven by higher demand for automotive vehicles, parts, and engines. These are things like cars, trucks, buses, motorcycles, and their components. Some of the reasons for the rise in imports are: the U.S. economy recovered faster than some other countries from the pandemic, boosting consumer spending and confidence. The stimulus checks and enhanced unemployment benefits gave Americans more money to spend on imported goods. The shortage of semiconductors hampered domestic production of vehicles, forcing automakers to rely more on foreign suppliers. The trade gap has both positive and negative implications for the economy. On the positive side, it means that Americans have access to a variety of goods and services at lower prices, which can improve their living standards and welfare. It also means that foreign countries have more dollars to invest in U.S. assets, such as stocks, bonds, and real estate, which can support economic growth and job creation. On the negative side, it means that the U.S. is borrowing more from other countries than it is lending to them, which can increase its debt and interest payments. It also means that some domestic industries may lose market share and jobs to foreign competitors, which can hurt their profits and wages. The trade gap is not necessarily a bad thing, as long as it is sustainable and reflects the comparative advantages of different countries. However, if it becomes too large or persistent, it can pose challenges for the economy and require policy adjustments.